One of my favorite things about commercial real estate are the many different investment strategies that it offers. There are almost an unlimited amount of different ways that you can invest depending on the asset type, property class, location, investment strategy, and more. Finding the right investment strategy for you is very important because that's how you're going to be successful in commercial real estate investing. So here are the 5 best commercial real estate investment strategies: the Commercial Bur, or value add, development, land banking, the long-term buy and hold, and owner occupied. Now, depending on your goals, you may choose to stick with one method, or you may diversify with multiple strategies. Up first, the Commercial Bur. The Bur method was made famous by bigger pockets. This strategy is the one that I tend to lean toward when evaluating my own investments. Bur is also known as the value add strategy, and it stands for buy, rehab, rent, refinance, and repeat. The Bur strategy is very scalable and can be used on single-tenant office buildings to garden-style apartments with hundreds of units. The key here is to find a property that is undervalued. This property could be in a distressed seller situation, but likely is going to need a significant amount of value add or just construction work. You'll want this investment at well below replacement costs. The second step of the Bur method is to renovate the building. Now, keep in mind that you're not renovating to comps in the area. You're simply renovating to increase the perceived value to tenants, which will allow you to increase rental rates and therefore increase the value of the property. The most common renovations for commercial buildings include interior and exterior paint, updated flooring, new signage and directories, and new lighting. While you may want to renovate above and beyond that, those few updates will make any building look brand new. Now that you've updated the look and feel of the building, it's time for you to get it leased. Unless you have a background in commercial leasing, it's best to lean on a leasing brokerage or property management company here. The quicker that you can lease out the space, the faster that you can move on to the next step, which is now for the fun part, the refinancing of the investment. After you've renovated the building and leased it up, it's time to pull all of your cash back out of the investment. That's right. If you performed the earlier steps correctly, you should be able to refinance based on a cap rate and pull all of your initial capital out of the deal while still owning the building and receiving cash flow. Now that you've got your capital back, you've built up your balance sheet, it's time to repeat the process again and continue building that portfolio of commercial real estate. Up next, we have development. Development allows you to completely reimagine a piece of land. You may be creating that project from a raw piece of dirt or re-envisioning what already exists on a property. However, development can be very risky. While it has the most potential to create wealth in real estate, it also has the highest potential for you to lose everything. It's crucial that you understand what you're doing and have the right team. The first step in real estate development is finding the dirt. There are many points of consideration when finding the ideal piece of land for your project. You've got location, zoning, topography, utilities, traffic, even demographics. And that's honestly an oversimplification of what you need to investigate. Each of these items will determine not only if your project will be successful, but whether or not you can actually even develop the site in the first place. Now, once you've found the ideal parcel that fits your criteria, it's time to put your vision to work. At this stage, you'll be working closely with a civil engineer, an architecture firm, and your leasing and sales team. These advisors are crucial to the deal because they help you determine the development feasibility, the proper site layout, the horizontal and vertical design, your marketing strategy, and so much more. The most successful developers in the world have curated a team of experts that surround them, which allows them to better coordinate the many different aspects of real estate development. Next, you'll want to secure a construction and development loan. Commercial lenders want to see an outstanding track record, especially considering how risky commercial development is. After all, they're not in the development business and don't want to have to step in halfway through a job to see it through completion if you go bankrupt. So your team and your strategy will be of utmost importance here. In addition to your engineers, architects, leasing, and sales team, lenders will want to review your operational team, your financial partners, and your project history. Having an excellent presentation will give your lender peace of mind and help you better plan for the success of your deal. And once you've secured your financing, your team will help you oversee the construction of the site. Doing so will ensure that the project is built to your standards and should help keep the project closer to its original development timeline. Choosing the right general contractor should be high on your priority list. I can't tell you how many issues we have had in the past with contractors that seem great and turn out not to be so. If your project runs into unexpected delays, cost overruns, or just shoddy work, your pockets will take a major hit. Your general contractor will manage the horizontal site development, so that's moving dirt, placing all utilities, think of everything in the ground. The vertical site development, which is the bricks and sticks of the building, and the interior finishes and warranties. While under construction, your team should hit the ground running with a marketing plan. Whether you're leasing or selling these units, any pre-leases or pre-sales you can possibly get will significantly reduce your risk, and the bank might also require it in order for you to get funding. Not to mention that will help you create momentum. Activity breeds more activity, and if prospects don't see much movement on the property, it could make them wonder why no one else is interested. Be sure to interview and hire the best leasing or sales team in your market that has a solid track record and understanding of your product type. Check out this video here on how to interview commercial real estate brokers. Next, we have land banking. Land banking is an investment strategy for the patient, hands-off investor. Essentially, you just buy land in the path of development and wait. No late night maintenance calls, no building repairs, honestly, very little work. As the development moves towards you, your property will increase in value, and then you sell it or partner with the developer to re-envision the property. Your investment in the land is basically a bank account secured by the dirt, hence the term land banking. When placing capital and dirt for the land banking strategy, you need to choose carefully and qualify the land properly. Be sure to understand how zoning and planning works within your municipality, as that will determine whether your investment will be successful or not. Review those documents to see how the city views the future of different districts. If the city has a plan for the future of an area where they intend to turn farmland into high-density commercial area or run a major thoroughfare from the interstate, that could be an opportunity for you to land bank. However, if they see the development going the other way and your land is probably just going to stay where it is, probably wouldn't make such a good long-term hold. Now, should you finance the deal? Some investors will choose to place debt and leverage their land investments. Others simply pay all cash. The path you take is completely up to you. There's certainly something to be said for owning a piece of dirt outright when it isn't producing any income. Many land bankers found themselves in some trouble in 2008 when they had to continue paying mortgage expenses, taxes, property insurance, and maintaining property without any money coming through the doors. However, if you can leverage and place the remaining capital in a different investment that will pay for your carry costs on the land, that's also a pretty solid option for you. Now it's time to plan for the future. When land banking, you'll certainly want to maintain the image of your land. Be sure to keep the grass mowed, the trash cleaned, and remove any squatters from the dirt. You never know when your land will become valuable to someone else, and you'll want to strike at that opportunity. While waiting for the value to increase, you could also put together proposed plans for the development of the site. These plans will help any brokers, developers, and visionaries see what could potentially be placed on the site, which could obviously make it more attractive. The fourth strategy is the long-term buy and hold. The long-term buy and hold has the most creative name on the list. You buy an investment and you hold it for the long term. You can utilize this investment method with a single tenant net property and skyscrapers alike. There are different reasons to invest in different building types depending on how involved you would like to be in the day-to-day operations. So first, determine what type of property you'll invest in. The beauty of this strategy is that it can be used on any kind of property. Whether you're looking to buy Class A office space downtown at a 4.5% cap rate or a distressed suburban shopping center with 52% vacancy, it could work. Here are a few factors for you to consider. Your involvement. If you want to be more active, you may be able to achieve higher returns on your investment. However, you can only invest in your immediate area or wherever you're willing to drive on a daily, weekly, or monthly basis. If you'd like to take a hands-off approach, you can purchase single-tenant absolute net investments anywhere in the country. Check out this video here on single-tenant net leases. Your risk tolerance. Are you looking to aggressively grow your wealth? If so, you may be more willing to take risk. If, on the other hand, you're simply looking to maintain your wealth, you want to place capital in a more stabilized and steady asset. Your overall goals. Do you intend to hold this property forever? You may take a different maintenance and leasing strategy for the investment than if you plan to sell in the next 5 years. Now it's time to underwrite the investment. You're typically buying long-term hold investments for the cash flow they produce. So it's critical that you properly underwrite the investment and examine any risks involved in the asset. Review the leases in place and consider the length of term, tenant credit, bumps in rent, and any future vacancies that could arise. If you're unsure about how to underwrite a commercial real estate investment, work with a commercial real estate brokerage or hire an underwriter to assist you. Once you've closed on that asset, it's time to handle the ongoing operations of the property. As the investor, you likely won't want to be involved in the day-to-day operations, especially if you intend to purchase more commercial property. It's just not scalable. From day one, you should hire a property management company and a commercial leasing team, if there is space that needs to be leased, to oversee the ongoing operations on site. Hiring an outstanding property management company can make all the difference with regards to excellent tenant relations, lower vacancy rates, preventative maintenance, and financial reporting and taxes. They'll work hand in hand with your leasing team to ensure that your investment performs at its absolute best. And they're incentivized to do that. If your investment is successful, chances are good you'll buy more property for them to oversee. Check out this video here on why you should work with a commercial property manager. And last, but certainly not least, the owner-occupied strategy. Ever heard of house hacking? Owner-occupied commercial real estate is the exact same strategy, except for, on commercial property, not a home. You move your business into the property and maybe lease to another tenant or two, and you use your business to help you pay down that mortgage. When using this strategy, it's important that you find a building that also works for your business. If your business can't succeed or operate out of the investment, you won't have it for very long anyways. The strategy is almost a business first, investment second thought process. Now, these investments can be multi-tenant situations, or you could be in a standalone building. It's totally your call. Most investors that take this route prefer to have at least one other tenant, in addition to their business, to help cover the costs of the building. Now, financing gets pretty interesting with this strategy. Depending on how much of the space you're taking, you could actually use owner-occupied commercial financing. These terms are, for a very good reason, better than your typical commercial real estate loans. Why? Because the lender's risk is lower since your business is operating there. Depending on your lender's requirement for owner-occupied, your business may need to inhabit at least 51% of the leasable space. However, I have seen lenders offer as low as 30% of the space. You'll find interest rates and down payments are lower when exploring this investment strategy. All right, so now that you know the 5 best commercial real estate investing strategies, check out this video here on the Commercial Bur, where I do a deep dive into how that strategy works. I'll see you there.